BT released their half-year results and their share price surged 11% in a day. But why did this happen? Well, we're going to have a talk about that today. So, welcome back to the Portfolio Podcast. Before we get started, I just want to say a massive thank you for all the engagement on the last video. Liam and I very much enjoyed reading your comments and looking at some of the discussions that have been happening down in the comments. If you are new around here, please do consider hitting the subscribe button and joining the community. We love having these discussions. You probably found this video because you've seen BT's share price surge by 11% on the 4th of November. And you probably want to know why, and that's exactly what we're going to talk about today. But just before we get started, as always, full disclosure, I do own shares in BT. I bought these just before the pandemic, so I have been hit a little bit hard by them on the share price at minus 18% currently. But I'm not particularly worried by this, and I'm actually looking at purchasing more in the future. A little bit about BT. BT is the world's oldest communication company. They've been around in one form or another, not necessarily under the name BT, since 1864. Back in the days of telegraphs and horse trekking ponies, or
they just have like thousands of pigeons and just throw them out.
Exactly, carrying pigeons. Yeah, but the thing is, they probably did during the First World War and stuff like that. They were heavily instrumented in the First World War, dealing with communications during that, and that's quite an interesting part. But it's not a history lesson today. It's an investing channel, so you can go elsewhere and watch. Earlier news or more current news: BT merged with DE in 2016. That took their share price to around 441 pence per share. Obviously, at today's price, it's now only 158 pence a share, so something's gone a bit wrong with that. And I almost akin it to what happened with Kraft and Heinz. BT Group currently cover a number of brands, obviously EE, because they've merged them, PlusNet, BT Sports. They own a stake in OpenReach as well. Now, that's a sort of multi-company venture. They only own a small portion of it, but it does exist under the BT Group, but it isn't part of the BT brand. It's quite a complex boundary between those two companies. But be aware that if you are buying BT shares, you are also buying a portion of OpenReach. BT are the market leaders in the UK for fibre internet, 4 and 5G networks. They have the largest share in all of those, so they are the biggest market player within inside the UK. More current news as well: they cancelled a dividend during the pandemic. Part of the reason for the big turn down in share price, part of the reason why I'm down so much on mine. Understandable at the time being, obviously, because they don't want to be hemorrhaging cash, and I think there was a fair few companies out there that did the same. We've spoken over the last couple of episodes, especially with the Cineworld video. We looked at Rolls-Royce as well. We're talking a lot at the moment about transformational companies, companies that are undergoing digital transformations, restructuring, stuff like that, to try and boost their growth, make themselves more efficient. BT is no different in this sense. It's another one of those that's been a bit down in the dumps, but there's opportunity on the horizon for potential growth.
And it is annoying, obviously, thinking about all those people that are losing their jobs, and it doesn't feel good to be profiting off that, even as investors. In my opinion, like I find it quite hard to. I did put money into Rolls-Royce in the end, but I did have a bit of an ethical debate with myself whether I'm just trying to profit off other people's loss of job, and it did send me into a bit of a spiral of, what other companies have I got that are causing havoc to local people in their area, but it is something that will keep the company alive, saving a lot more jobs than they're losing.
Yeah, saving the jobs they're not losing, and also when they get back to growth, they'll get back to recruiting people. So eventually it'll go full circle and they'll be recruiting people again. So it's not great for the short term, but ultimately it's necessary. Pros of BT then, just brought back their dividend. That is one of the big reasons for the share price surge that's been going on. They've put in a target down for 2022 of a 7.7 pence dividend, and they've already declared a 2.31% dividend for February. At the current market price of 158 pence per share, that's a 4.88% yield, which is healthy.
It's a healthy yield, yeah.
Yeah, absolutely. I think it was actually sitting at market open before the results came out at 5.3%. So obviously most dividend investors aim for that 4 to 4.5% yield. So you can now see why that 11% surge has sort of happened, because it's trying to catch back up to that. So people go, oh, this is actually a really good dividend yield. I better buy some more of it. We spoke about as well, obviously they're a transformational company. They've already delivered £1 billion in annualized cost saving, and that was actually 18 months ahead of their target, which for me is actually quite mind-blowing, because normally most companies you see set these targets and they miss them. But to over-deliver by 18 months is absolutely phenomenal. So
yeah, it's quite crazy.
Due to this as well, they're actually going forward, and they have an extended target of doing $2 billion in annual cost savings. They were trying to target completing that by financial year of 25. They're now bringing it forward to financial year 24. So that's absolutely brilliant. That's showing a strong recovery. their restructuring efforts and their cost saving efforts and their efficiency efforts are paying off far quicker than they even planned to.
You know what I think that shows, in all honesty, what I think that shows as a company is that they have a plan and they're actioning the plan, which you see a lot of companies make these plans and they half-heartedly do them, and you see some change, but saving $1 billion in annualized costing in 18 months ahead of target just shows that they're actually actioning their plan to the best of their ability.
Yep. And the people are supporting it in one way. Obviously, if there's layoffs incorporated to that, then obviously that's not the great part of it. But you need your people to deliver the cost savings, come up with the efficiency ideas, come up with the areas that they can cut costs in. And if they're delivering ahead of schedule, it shows they've got the people on the team that are willing to do that. Another product they've done over the last few years, a really heavy investment in fibre optic and 5G rollout. Big investments to make sure they retain their market leader status. Now, that's cost them a lot of money over the last few years, but those investments are going to start paying off. It's going to start improving their cash flow. And you can see that in their forward-looking numbers where they're talking about it. They're trying to get to a £1.5 billion increase in cash flow, and they are getting there. And those huge outgoings are now starting to deliver those profits they were looking for. Other pros for financial year 22 and 23, they've reduced their capex spend, so capital expenditure. So that's spending money on facilities, hardware, stuff like that. They've reduced that by £1 billion a year. Now, obviously, sometimes that investment's not a good thing, but in this sense, it's a good thing because I think BT were overextending themselves. They're also reducing their OPEX spend by 500 million, so that's operational expenditure. So that's money spent to keep the company running, for want of a better phrase. So increasing that while maintaining revenue is an efficiency increase. Interestingly as well is their revenue for the period was actually down 3%, but their profit was up 5%. So that just shows those efficiency drives they've been doing are actually paying off. So despite the fact they've actually brought in less money, they've made more profit. I did say there were a lot of pros, and there is. I've had to go on to a second slide with this one for once. FTTP. Yeah, exactly. FTTP stands for fibre to the premises. So this is the stuff they're doing with OpenReach. So this is fibre optic cable going between businesses, houses, stuff like that, and delivering that super fast internet. Now, interestingly, again, BT were actually looking to sell off their share in OpenReach at the time. Now, what's happened is that they're actually delivering ahead of time and below budget these fibre optic properties, and because of that, they've now decided, we're not going to sell our share in OpenReach because it's actually becoming far more profitable to hold it. So again, this is another mind-blowing one for me, being in an industry that's always late and always over budget, that a company's being on under time and under budget. Another positive I saw with inside their numbers was that they actually have a £5 billion tax loss they can take forward, carry forwards with them. Now, this is from something called a tax super deduction. So what happened is that the UK government, where their people are investing heavily in infrastructure such as 5G and other projects like that, they can actually get bigger tax breaks. Their reported EPS was 4.4 pence. Their adjusted EPS is actually 10.2, so that adjusted takes into account a load of exceptional spendings they had to do and pay out for this quarter. For this half at least. Even if you just look at the dividend against the reported EPS, the payout ratio is only 52%. In reality, when those exceptional spends aren't in the second half, that's going to increase even further. So they're in a really strong position to continue paying out that dividend. Other positive sign, they've got a strong cash balance. They've got 2.6 billion on their books, free cash, ready to either invest. As always, there are some cons, there are some caveats underneath some of those pros that we do need to discuss because they give you the headline figures, but until you drill down, you don't see some of the issues with it. So one of the big cons I noticed is their revenue has been declining year on year for several years now. It's been continually decreasing. A lot of that's to do with sort of legacy technology and legacy contracts expiring. So copper internet, using copper wire for internet is something that's expiring. It's something that's going to be costing them money. It's a market sector that's going to be declining. Obviously, the investment they're doing in fibre optic is going to start writing that off, but they're sort of in that transitionary period where we're moving from primarily copper based to primarily fibre optic based, and that's going to have a big effect on them. One of the cons, obviously, they've brought back their dividend, but it's about half of what it historically was. I think in 2018 they were paying a dividend of around 15 pence per share. Now you can look at that in two ways. You can look at it, okay, if you own shares in 2018, obviously the share price has probably plummeted to match it and keep that dividend yield similar. But you can also look at it in the sense that, right, okay, well, they're still earning a lot of profit. They're still earning a lot of money. That's given me a lot of room for dividend growth because the underlying profit is sort of similar or will be similar in their forward-looking numbers towards that 2018 dividend. So potentially the dividend could have a shocking great increase over the next sort of 2 to 5 years, and that might be a really good time to buy. could be potentially forward-looking, be undervalued. The annualized cost saving they were talking about in the short term, it's annualized, so it will save them that much money a year, but it's cost them money to do that. So to save that £1 billion, they've had to spend 571 million. So obviously, if they're doing layoffs, stuff like that, that's going to be redundancy checks. It's going to be spending money on equipment that saves them more money in the future. And their £2 billion target is going to cost them about 1.3 billion. So in the short term, they're spending more money.
Even from that, the 7.7 billion, which is nothing to be moaned at.
Mm-hmm. Exactly. Yeah. In 1 year, they've saved themselves 700 million by spending 1.3. Yeah. Exactly.
And if they can then continue to save 2 billion a year, that's ridiculous. Like that's more than most. I think even our company did a similar sort of thing with a project, didn't they? And I think that took longer than expected, and didn't have an impact that was ridiculously huge. It did have a big impact, but nothing that was too crazy.
Yeah, I think ours was about 1.5 billion. They're targeting another billion, so they're similar sort of numbers, but they weren't. I think they were achieved. They weren't slightly behind time rather than 18 months ahead of time. Declining robo revenue. So, as we spoke about before, one of the biggest drains on their revenue was actually their global market. I think it was down something like 14% for the year. Now they've stated COVID as a reason, but there wasn't much explanation behind that. Now obviously they know the numbers better than we are and they'll know the impact better than we do, but you're seeing a lot of companies report where they feel like they can just blame COVID for things. Obviously they know the numbers better than we do. I'm not stipulating anything there, but it is one of those we just need to be aware of, that the global market condition is weaker for them, and it has delivered them significant drop in revenue for their particular market sector. Their debt pile sitting around 12.2 billion. That's an increase of 8% in half one. Now, you might be thinking, well, hang on, they were more profitable. Why is their debt increased? Now, interestingly, when you look at their financial reports, the pension contributions don't take into account against the profit. So they made £483 million, or whatever the exact number was. But they had to then contribute £600 million into their pension portfolio on top of that. So they actually had to take on debt to pay into that pension portfolio.
So they've got a pension deficit.
Pretty much.
They're trying to top it up.
Yeah, exactly.
And
so they're trying to top
them massive debt.
Yeah.
So they're doing the right thing for their employees, but they're doing a weird thing for the company realistically, because if they're going to put themselves in debt every year until they get out of this pension crisis, then that might never happen.
Yeah. So they legally have to top up the pension because they've got a commitment to do so. Yeah. But what we spoke about before as well is they had some exceptional expenses in the first half of the year, which they won't have again. So when you take those out, something like £580 million, and you incorporate that into it, they're back in profit again anyway. So it's a one-off expense.
And I suppose then from next year, this 1 billion per year will be saved, and that could then go towards decreasing that debt, that saving.
Exactly, and that's what you want to see. Is you want to see that debt value coming down. But I think they're just now at the cusp where they've got themselves in the right position. That's why the positivity's there, and they're going to start paying dividend out because they're at the cusp now where they're going to be the right side of it, and that debt is going to start decreasing. A lot of the stuff in the headlines was about today's news, the share price, the earnings and everything else like that, so I had to dig a little bit deeper because I don't want to recover the same information. Obviously we've already spoken about Openreach doing better than expected, so they're going to retain that, but I think we spoke about with somebody in our comment section previously about the possible takeover bid that could be going over with BT. It was all rumours, it was all stipulation, but there has been some more headlines in the last couple of weeks that have been resurfacing about that. So one of the companies that we're looking at was Altice. They currently own a 12% stake in BT. Now, they actually have a contract which says they can't pursue any other BT ventures until after the 10th of December. Now, that's coming up very, very quickly. So there are rumours circulating that they may potentially try and launch a takeover bid. And judging from what I'm seeing in the news about BT hiring people to try and protect against a takeover bid, it's probably going to be a hostile takeover bid. There was also headlines about DT, which is the German equivalent, Deutsche Telekom, as opposed to British Telecom. So they also own a similar 12% stake, and there's a statement here that I just want to read from their CEO, Tim Hedges. In the next 12 months, something is going to happen around our 12% stake in BT. We're entertaining all options. We have a lot of optionalities now on the table in the BT business. We will do something which is a good deal. So again, that's a positive thing that they might be coming to look over here. And historically, when we've looked at takeover bids and we looked at what happens with Morrison's, when you've got two competitors that might go at it, the share price goes up because they keep increasing their bids, so it could be one to profit off. Now,
So this could be a nice growth potential in the short term, but
yep.
even though they're bringing the dividend back, if there is a hostile takeover, we're just getting our shares taken away from us realistically.
But if they get taken away at a premium, that's not the end of the world.
I mean that's great, but you know, at the end of the day, as dividend investors, we just want to see nice, steady, easy business.
Now, interestingly, on this takeover bid news, the last time there was news circulating, serious news circulating about this, it actually drove the share price up to 205 pence a share. So that's sort of a 30% increase on where we are now. So even still, if it's a short-term investment and you seriously think there is going to be a hostile takeover bid and BT aren't able to defend against it, which I don't think is probably going to happen, even still, it could have an impact on the share price. Forward look then. Returning dividend target 7.7 pence for the year, as you mentioned, 4.88% yield. Fantastic, great, right in line with our target, right in line with what we want to hit in our portfolios. So great news. If the numbers stay positive and they're targeting their progressive dividend, then potentially, as we mentioned, if their dividend returns to what it was a number of years ago, you could be looking at current market price of 10% dividend yield against what you buy as. So for me, that's really, really positive. It's the sort of thing I look for, that growth, and that massive growth in dividend is going to be great. So although you're buying them now at only a 5% yield, in a few years' time, that yield's going to massively increase to 10%. Those increasing numbers we're talking about now, they're going to be supported by the growth in their 5G and fibre. Now, obviously, they've done the huge expenditure on doing it. Yes, they're still having to spend money to complete the rollout, but they will start now seeing a return on that, and that'll support the positive numbers. Strong turn in numbers as well is obviously going to lead to good capital gains on shares. We've spoken previously, we don't always look at the capital appreciation of the share price, but given the numbers that go on here and the returning dividend and the dividend growth that is potentially being predicted going forward, there should be a strong bounce back in share price.
What I'm just really interested about on that dividend chart at the bottom of the page is that back in 2011 they did a very similar thing.
Yeah.
So, and then there's a nice big drop there from 2007 2008 as well. Like, it seems that they're just regulating their dividend, trying to not let it get too big. That's what it looks like to me on just on a first glance.
Yeah, without being able to know the full numbers, I suspect obviously 2007, 2008 is going to be financial crisis. That's why it's got cut off there. And then 2011, maybe they cut it because they were saving money in order to buy out EE, potentially. That might not be the actual reason, but if I was doing a broad view, that's what I might say. Somebody might be able to correct us down in the comments and just tell us why those two drops are there. Final thoughts from myself. Very positive news. Numbers are going in the right direction. Cost saving is above target. Revenue growth is coming back on the cards. Profit is increasing. They're going to start being able to pay down their debt. Really, really, really strong outlook for this company going forward. One thing I would be wary of, obviously, the 11% gain a day is quite significant for a stock. Obviously, in crypto, not so extreme, but in a stock, that's quite extreme. So just be wary. There might be a bit of a retracement over the next couple of days if people have overdone it. I don't think they have, so I don't think there's going to be too much of a pullback. That's my personal opinion.
There will be a pullback. There always is, but I don't think it's going to matter to us on that couple of percent. It might pull back a little bit.
My personal opinion is I'll be expanding my own holdings in them. So I'm 20% down. It's at a discount from what I bought them at when I decided I thought they were a good share price. Now they're bringing a dividend back even better. It's got a good yield. They're showing good positive growth. So it's a great time for me to lower my entry price down. Liam, I don't know how much of a look you've had into them now. You've only just seen the slides that we've put up here. What's your opinion?
I mean, so I looked into BT a while back, and at the time all I saw was zero dividend, and EPS was all right, dividend cover was all right. Looked into it's not my sort of field, the communications field. I don't understand it enough in that technology side of that technology space. Like, I understand a lot more of I understand a lot of the tech industry stuff, but when it comes to communications, I have nothing in my brain about it. And I feel like I like to have some sort of knowledge about how something's going to work, even if it's just a broad overview of how something's going to work to invest in it. But after watching this video with you, I think that I will be looking a bit deeper into it, and I will just go out and try and find that information that I'm lacking about communications, just so I can build my own knowledge, so that when I invest in that company, I'm not investing blindly.
Exactly it. Exactly. And there's a lot of investors out there that literally just say invest in what you know, invest in what you understand. And that is absolutely it.
It's not all about investing what you know. It's invest in what you you need to go out and find the information, because most of these industries, you're not going to have a Scooby-Doo what's going on in any of them. I mean, do you think I know what they're doing in Pfizer, BioNTech, or anything like that? Do you think, I don't know what they're putting in those petri dishes,
Yeah.
but just with that broad, that background knowledge of like, where are they based? What is each research facility doing? How is this partnership working? And that sort of thing. Even if it's a broad level and I have no idea what's going in the petri dishes, I still know about the company. And I don't think personally that the annual reports and director support and presentation, the investors' presentations do all that for you. You have got to go out and do a bit of Wikipedia searching.
Yeah.
I know it's not massively accurate in a lot of respects, but when it comes down to companies, a lot of them manage their own, so you can see a bit more information from sort of like the marketing side rather than the investor relationship side, and you get a bit more of a wider understanding. I think that's really important for all of our videos, is to do that extra research, because we're not financial advisors. It's just our own opinions on this.
And this is exactly why we stick that at the slide at the start, a bit about the company. Now, it's only a very, very brief snippet of stuff, but we will look more into it, and you're absolutely right. You need to at least have a basic understanding of what the company does and how it operates. It's really, really important, rather than just looking at it in terms of numbers.
So we got a comment from the last video. Very exciting. Very interesting, gents. Thank you. Rolls-Royce are also working on small modular reactors, which could provide clean energy, which is, a great point. And we did see that before we did the video. At the time, we didn't think it was too relevant to what we were trying to push towards in that video. But I think, we probably, based on some of the comments we've had, I think we definitely should have maybe touched on it. What do you think, Ryan?
I think I did briefly mention it in the video, and I actually responded to Lisa's comment here. What I was sort of my blue sky thinking brain going off on one, it's like, okay, well, they're doing small scale nuclear reactors, obviously, for industry and stuff like that. But obviously, you think about up and coming space economy in general, space mining, space tourism, however the economy in space is going to go one day, it's rapidly progressing that way. And space is the perfect area for small scale nuclear reactors to power ships and stuff like that. So if there's a growing industry there, they could be positioning themselves so they can do that. Now, I'm not saying that's the way they're thinking, but it's an option.
It could be. Death Star incoming.
Exactly.
What's the next one? Jake said, how are you guys just buy stock for long-term investing? Right, so we aren't looking for those short-term big gains, because yes, you can get them, and yes, they're very nice. And I think Ryan's hit a few. One of my friends hit a nice one on Cineworld. But what we're trying to do is to invest in our future. Our hashtag is fund your future. We're not worried about earning a quick 500 quid now. We want to be earning £500 every quarter from the dividend of one company, and another £2,000 from another company. The point of this is to take it slow and just enjoy that passive income. We're not sitting on charts day in day out trying to time the market. And there's many people that are very famous and very rich that say time in the market. In fact, I was watching one earlier saying time in the market is not the way to go. You don't want to be sitting on charts for 6 hours waiting for it to line up perfectly to get that entry point to try and work out
I've done it.
It's not healthy. I've done it with Forex. I've sat at charts for 5-6 hours and just trying to get that perfect entry point. Trying to see it just hit that perfect number so that I know it's going to skyrocket and hit my take profit 3. But it just overcomes your life. Whereas with this, on payday, I go on, I look at the companies I've got a list in my notepad of other companies that I've been looking at and gathering information on. For example, yesterday I had a stock meeting with my friend. We kind of trade together, and we were looking into Verizon. I don't know if you've heard of them. And we put 2-3 hours into looking into their stock, and that just about got us through the annual report and one of the quarterlies. We're still going to look at the investors' presentation. We're still going to look at the news. That's another 2 hours. And then there's another 15 companies on that list. But I can take my time with it because I'm not in a rush. I'm not in a rush to find that perfect entry point for Verizon. I might not invest in them until next year.
And that 2-3 hours of work that you've put in there will actually, if you do your research properly, will actually stand the test of time for the next 5, 10, 15 years. So in the scheme of things, it's a much smaller percentage of work to get a much larger gain.
So yes, you could probably make £500,000 on the stock market if you're really good at it, and you're one of those, what is it, 20% of people that don't lose money trading stocks.
That, I think, yeah.
Is it less than that? Yeah,
it's less than that.
Well, if you actually look at the amount of people that do dividend investing, the amount of them that lose money is a lot less than the people that try and time the market. And I believe even Grant Cardone said that timing the market's hard work. Like, it's a lot of work. Whereas this is not a lot of work. I go on my phone, and 10 minutes later, I'm off my phone.
Yep. And even less work is if you really don't want to do your own research, then obviously you don't want to watch these videos, for example, just invest in a hedge fund. But this is precisely why we do those videos, to take that 3 hours of research and just condense it into a 20-minute, half-hour episode. So.
Yeah, and we've kind of got a lot of the figures in here that are essential. You know, we've got all about the EPS and the dividend. We're looking at the debt. We're looking at the revenue increase or decrease over the years, and we tell you the trends. But the things that we can't tell you is like your gut feeling at the end of the day. And I do think, even though you work with logic throughout investing, I do feel like gut feeling can tell you a lot. If you look at a company and you read through the annual report and you go, yeah, it looks good, but I don't feel it, don't invest.
Yep, I've done that tens of times.
Yeah, and you could spend a couple hours looking into a stock and then just go, yeah, but no, don't like it. And I've done that. I mean, there's many companies that I've looked at and gone, no. Yeah. But just to solidify with Jake's point here, Jake, if you're listening to this one, we are only looking at dividends. We are not looking for those capital gains. Yes, we have mentioned about earning money off the stock price in this one with a potential takeover, and we're not opposed to taking those just already set up potentials. You know, if they're there on offer, we'll scoop them up, but we're not searching for them. I think that's a nice way to end that.
Yeah. Capital gains are appreciated, they're great, but ultimately it's not exactly what we're aiming for. I mean, I've got obviously the crypto side of it, and that's my growth potential side of it. So I generally don't, in terms of stocks, I don't look at growth stocks very often at all, because I've got such a large exposure to crypto already. There's no reason for me to do that. Liam, obviously, because he doesn't have the crypto exposure like I do, you generally are more comfortable taking on riskier stocks than I would be, because you don't have the same level of exposure. So.
I mean, I still have my Forex account. It's just a small account, and, you know, I only use it really for fun, you know, and I'm not going to take these, you know, couple of minute trades. I'm taking long-term trades. Is GBP going to go up by quite a bit against Euro in the next week? Yeah, I'll put some money in, little bits, you know, because I don't believe timing the market is the way forward realistically, but it can be good fun.
Yeah. Anyways, we've spoken enough. I want to thank you very much for watching, if you are still watching, and we'll catch you next week. See ya.
See you later, guys.